Okay, it's 11 o'clock. I should get going. Hopefully, no technical failures this time. But normal sort of pattern, we're going to run through some news first, and then I'll be talking to Alex Crook of Bankers Investment Trust. So news that I pulled out this week is there on the screen. We start with Blackstone loan financing first. This is a relatively obscure fund, I suppose, but it was quite big, or is quite big. And actually, I think it's done a reasonable job. This chart that I pulled out from our system only goes back to 2019, sort of like, yeah. But if you go back to the start, it's actually produced decent returns. Most of them sort of from the income that it produces. It's on a biggish discount, and it has been for a long time, and that was part of the problem. But the yield is enormous, and that's because of the way that it invests. So it's a structured debt fund investing in collateralized loan obligations. So these are parcels of debt that are sort of divvied up into tranches, where the senior tranche is the least risky and gets a low return, and at the bottom there's kind of equity tranches. And this is what this fund was holding. So it was creating these CLOs by packaging debt together, then selling off the interest in all of the junior things, senior things, sorry, and keeping the junior stuff. And as I say, it's got a pretty good track record. And it did grow and grow. There was another fund called Carador that it absorbed with an issue of C shares, and then that all got merged in. So it was quite big. But the discount started to open up. And in January 22, the board started to talk about what should we do with this thing. And initially it was saying which we're going to have a continuation vote in 2024. But then by the time we get through to June 23, it said, well, we're going to just wind the thing up. The discount's more than 30%. We can't grow it anymore. Because of the way these things are structured, and they will have a sort of a life, and it's quite hard to break them. We're just going to sit there and let them run off, and that will take about 7 years. And they started handing money back earlier on this year. And then they announced another chunky return of capital just a few days ago, the 61 million euro one. But today they said we've agreed to sell the holding vehicle that holds the portfolio, so all of the underlying CLOs, to an affiliate of the manager. So this is a related party transaction. So that means it all needs to have shareholder approval for about 304 million euros. Because they want this to be completely above board, none of the kind of connected shareholders are going to vote on this. But the independent shareholders holding 28% of the company have already said, yes, we will vote for this. So I think it's quite likely to go through. The good news is, obviously, instead of taking 7 years, and there was a big chunk of money they're saying will be able to come out until 2029, you'll get everything now up front. In terms of the amount you're getting, it's a premium to the last closing price, which is obviously tick in the box. But it's a discount to the underlying NAV. And there are two different NAVs here. So one is a theoretical NAV and where they think the prices should be, and the other one is based on where the prices are. And it's just slightly tighter. I think if you look at that 4.3% mark to market discount, really, this isn't a bad deal. I'm not a massive fan of selling things off cheaply, and you know that I moaned about owning property income, and they sold that on the cheap to get the thing done quickly. But I think here this sort of makes sense. So the plan is they're just going to sell everything off, distribute the proceeds, and then delist it with the sort of little run things to tidy up, and then go into liquidation. So I think this is probably good news. Edinburgh Worldwide, we know that this has been pretty dreadful in terms of what's happened to the NAV since rates started to go up and growth stocks derated, and it lost an awful lot of value. And it's been sort of going sideways for a while now. But you can see this sort of at the end there, a slight tick up. And obviously the discounts come rattling right in. So today the discount's only about less than 5%. And that's obviously good news. But back in the days when it wasn't tight, the board said we need to hold a strategic review, we need to think about what's going wrong here. They've tweaked what's going the way that things managed. So the two deputy managers, Lucas Svetlana, have been promoted to co-managers. So there are now three co-managers alongside Doug Brody. And they just think that's going to be a sort of better sharing of ideas, really. They're trying to make it a slightly high conviction portfolio. So they've reduced the number of stocks in the portfolio to between 60 and 100. They're benchmarking it against the S&P Global Small Cap. They've been doing that for a long time, but this is kind of now being enshrined into the investment objective. But the portfolio will not look anything like the S&P Global Small Cap. And I'll show you in a second where it is now. The other big change is that they used to say small cap is anything less than 5 billion, and we won't buy anything that is more than $5 billion. Now they're going to say it's the market cap of the largest stock in their benchmark index immediately off the index to balance. So basically, everything that's too big gets pushed into the large cap index anyway. And so what you're left with, the last September, the largest stock in the index was $29.5 billion. But currently it's about 44, but that 44 billion market cap stock will probably get promoted. So that's really quite chunky. That takes you quite a long way into the FTSE 100. And I was a bit dubious about this, but I don't think it's going to be a routine thing that they're going to be buying really massive companies. If you look at the mean and the median of the market caps in that index, and there are 11,000 companies in the index, it's more like 1.5 billion for the mean and about 800 and something for the median. So I don't think we're going to see a rapid kind of move up the market cap scale. This is not perfect, but this is their breakdown of where the portfolio is on the fact sheet, and this is the breakdown of where the index is. And you can see there's quite big differences here, and that reflects the skew of Edinburgh Worldwide towards growth stocks. So it's got nothing in energy, nothing in utilities, that sort of stuff. So it's just reinforcing that message that regardless of what they're doing here, they're not going to be trying to replicate the index, which is obviously a good thing, I think. And then the other thing about this is I've been a bit antsy for a while that SpaceX has become such a massive part of the portfolio. So this is at the end of October. Baillie Gifford are quite good about revaluing things on a regular basis, and that percentage has gone up. I am not sure, though, whether they've fully revalued it to reflect this tender offer that's happening in December. But what I'm kind of hoping, and we're just going to have to wait and see, is that they use this opportunity in December to try and reduce that stake a bit, because I think it's just too large a part of a fund that's supposed to be a small cap fund. And obviously this is a very big company now, even though it's unquoted, it is a very big company. And it's a lot of stock-specific risk as well. So we'll just have to see what happens in December. The other thing that they said in all this was we're going to cancel the share premium account, which creates about a £500 million distributor reserve, which is a good thing to do anyway. It's just good kind of practice, I think. It just gives you the board some flexibility in case you need to do anything, in terms of retaining capital. This needs shareholder approval, but it's quite straightforward. Lots of other funds have done it. And it will carry on with buybacks where it needs to. It's already bought back a fair chunk of shares this year, but it's kind of committed to return £130 million next year. I think that's slightly too aggressive. So basically, if the discount now is 4.7, there doesn't seem to be much point in handing money back. If you want to sell, you can sell in the market. And there are discount-driven shareholders on the register, notably Saba, which has been stalking a whole bunch of different funds. But I kind of feel like if the thing's trading at a fairly tight discount, there's no need for the board to be doing anything to facilitate an exit for it. And so we'll just have to see what happens. But I don't really want to do tenders or anything else unless they really, really need to. So that's that one. And then just very briefly on Miton UK MicroCap, we've talked about this. It's tiny now, partly because of the performance, partly because they keep doing these annual redemption opportunity things. The discount has been quite stubborn. That hasn't helped, which just reinforces what I've been saying for a few weeks now about these annual redemption opportunities. They don't work. And this time round in October, they lost 40% of the fund. And so it really is too small now. So they've talked to shareholders about what to do and decided they're just going to wind it up. I think it's a real shame. They are offering you a chance of a rollover into a current open-ended fund, but I don't think that microcap stocks sit very well in open-ended vehicles, to be honest. I just don't think they're liquid enough to do that. I think it's much better to have it in a closed-end structure. And I suggested on when we read the news that there is still River and Mercantile microcap is the last one left. So maybe there was a way of trying to switch into that. But the real sadness, I think, here is that we've had this pressure on the UK stocks for a long time, pressure on the small cap for a long time, and then this pre-budget massive sell-off of AIM. And it feels to me like this is kind of the bottom of the market, and this is not the right time to be selling stocks, but there we go. So that's enough for me.